I would like to be this session in English, if you are all okay with that, because I don't have any problem in speaking English, but बीच बीच में कभी कभी हिंदी निकल जाता है. So if that is okay with you, then that will be really nice of you all. Okay. So let me share you something about me. I mean, it's not a very profound introduction that you'll be getting, but it's a very small one. But yeah, I've been having in this field for last 9 years. And currently, I'm working as a quantitative trader and a data analyst in a firm called Blueberry Capital, which is based in New Delhi. Right. So here, my role is to extracting insights from their trade data and developing new strategies. In short, I have to generate alpha using machine learning and deep learning techniques. Right. And currently, I've been working there for last 2 months. And my long-term goals, if I talk about, then not today, but let's say after 5 years, 10 years down the line, I think that I'll be able to start my own trading desk. So this is about me. And let's talk about the agenda of the session. For that, just give me a second. Yeah. Okay. Screen is visible to you all. If somebody is not able to see the screen, then please just once update on the chat. Then I'll be able to see what's the issue, right? So agenda of the session is, as we already know, it's about hedging strategies, right? And today what we are going to do is like we'll be looking at various types of hedging strategies which basically help us in managing our risk in financial markets. So we are all here who are basically interested to know about how basically we can become more profitable. And if we have to make money, here we have to take risks. So how can we mitigate that risk? This is where the hedging comes in. So we'll delve into a lot of hedging strategies. And basically, I would recommend you to keep a notebook with you. So if any doubt comes in the session, you can note the doubt. And at the end of the session, there will be a Q&A session. So we can discuss doubts there, right? And I expect a lot of you, there will be a lot of people for whom the session will be a bit introductory, or a few topics will be introductory, or can say like a bit simple. So I basically request you all to stay with the session, because there are people who don't know the same things that you know, right? So for all the learnings, for all the people's learning, let's just keep with the session. Okay. Once again, thank you all for joining us, and let's get started. So introduction to hedging strategies. First and the foremost thing which comes in our mind is, what is hedging, right? So hedging is something that you can think of as an insurance, right? You can think of as a not life insurance. You can think of as a health insurance, because life insurance, there are a lot of people who take it as a negative thing. But let's say if we talk about hedging, what exactly hedging is in financial markets. So basically, if you have a position which is exposed to a directional risk, you have some shares of a stock, let's say Reliance, of at 3,000 rupees, and there is a risk that it can go bankrupt tomorrow, right? So you have a directional risk. In order to mitigate that risk, you have to have that hedge in the market. So even if it goes back to 2,000 or 1,000 rupees, you won't incur big of losses. So the definition is, hedging is basically a risk management tool or strategy which basically offset your potential losses in adverse market conditions, right? By making another opposite direction position, right? Think of it as an insurance against market volatility. Uh, all of you might have been in the markets when this election results output came, right? So then the market dropped by 2,000 points, close to 10%. So people who just initiated their longs a few days ago would have incurred a lot of losses, right? Without the hedge. And if they were leveraged, over leveraged, it was like cherry on the cake, right? So that's the only reason that the hedging is useful, where such kind of adverse conditions you can take care with hedging, right? So this is the purpose of hedging as well, right? To reduce risk. And if we'll be able to implement the hedging strategies, right, we can protect ourselves from a lot of such black swan events, which may or which can hit us so bad that even we can go bankrupt with the trading capital that we have. So that is something that we need to keep in mind. There are multiple hedging instruments that we can we have seen, but there are a few very important and key hedging instruments that we have: forward contracts, future contracts, options, and swaps. Forward contracts is something basically, if we talk about that, forward contract is just an standardized version of future contracts. Everybody has seen about, we have seen futures contract in our exchanges getting traded, right? Currency derivatives or commodity derivatives, or let's say our stock derivatives, indices futures, right? So forward contract is just something where there is no regulations. There are two parties which are involved in making that contract. It's just like verbal basis, or it's unstandardized, right? So there are two people, A and B. They just decide and they agree on a price and a specified date, and this is how the forward contract basically is built, right? Just a second. We'll take an example of forward contracts for you to understand this better, right? So let's say consider an Indian farmer who's basically growing wheat and is concerned about the price drops, right? He expects that his crop must at least give him 1,000 rupees per quintal, right? But he is scared of the price drop, right? It might go to 800, 600. So what does he do? He finds a buyer and he basically makes an agreement that he'll be selling him this many of quantity of wheat at 1,000 rupees per quintal, right? Now you might have a question that why, if the notion of bearish outlook, if somebody has, why will the other person will get into this contract? Because the reason is markets are run on differences in opinion, right? So the farmer has this notion that the prices may drop, while the other person who's getting into this contract, he has this notion that the prices may rise, right? So that's the only thing that the transaction is happening. Now, uh, this is how the forward contracts is built, because there is no third party. There are only two people, the buyer and the sellers are involved, right? There is no other regulatory is involved here. If any of them goes somehow, if any of them does not fulfill their promises, there is this third party risk to the person who's getting into this contract, and the delivery is not happening. Then he might have made a promise further. If he won't be getting the delivery from farmer, he'll not be able to deliver that there, right? So there may be a penalty involved. So that's why in forward contracts, because of lack of the regulatories and unstandardized version of it, there are chances that you might incur some losses in this, right? In such scenarios. While if we talk about the futures, in futures contract, they are similar to forward contracts, right? But they are standardized and traded on exchanges. They require margin deposits and daily settlement, right? While forward contracts does not require margin settlements on day-to-day basis, right? So let's say if the price of uh, the price of that we were talking about, somehow in the middle of their agreement goes to, let's say, 200 rupees, right? So the person who has agreed on a price of 1,000 rupees to buy it on, he might think that if I'll be buying this, I'll be incurring huge losses, right? So he basically can disagree on what promises he has made, and that's how the farmer, where he was expecting 1,000 rupees, he won't be getting transacted, right? So that is the problem with forward contracts, which is taken care by futures. Because if futures are standardized, if a lot of people are trading in the futures, then the liquidity problem does not come. And second thing, if the daily settlements are happening, so a person who's like giving 1 lakh rupees margin to buy one particular lot, let's say, and if he incurs a loss of 10,000 rupees on a particular day, the broker will ask him to deposit that 10,000 rupees. So mark to market, the MTM is settled every day. So there are less chances for a person to, there won't be having any sort of liquidity problems in futures markets. Third is options as hedging instruments. lot of you are really interested in understanding options, because as we have seen after COVID, the people are getting into options and specifically in option selling. So it is a very key point and a very important thing that we are discussing here, right? What is an option? Futures we have understood, forward we have understood. Option is nothing but a tool which is giving you a right to buy or sell a particular asset at a price which you choose as a strike price and an expiry date. So how does that work, right? Now, if you think about it, let's say uh, if you have this notion that Reliance Industries can go from 3,000, that is the current price of it, can go to 4,000 or can go to 2,000, right? There is this result which is due and it will be published in a few days, right? So there are chances that in this volatile scenario, you are 60% or 65%, you have this probability in your models or in your mind. Somehow you have this notion that that this is the outlook of it, that it 65% chances that the stock may rise by 1,000 points, right? But there is 35% chances also that it might drop, and there are adverse chances also that it might drop to 2,000 also. So if you will be getting into a cash or an equity position at 3,000 rupees, you will have you will have to take that risk as well, where the markets can go against you and can give you significant amount of losses. That's when options come as a handy tool, right? So what you can do, if you are so sure about this, you can buy a call option of 3,000 rupees. And if it goes to 4,000 rupees, it will, once it goes ITM enough, and it's delta. What is delta? We'll get into it a bit later. But just think, delta is something which is just like we understood that y is equal to mx plus c, right? So how much change in x happens, on basis of that, m is somewhere in this equation will work as a delta. So if 1 rupee is 1 rupee increment is happening in the cash, how much is that particular option is increasing, right? So that is called the delta. So if 10 rupees uh, increment that we have seen in the stock prices goes from 3,000 to 3,010, and if the delta of it is 0.5, half of it, then it will mimic the half of the move that happened in the cash. So the premium of the option will increase by 5 rupees, right? That's how the options work. Why do we want to do this? Because we want to avoid the risk. In that scenario where we already had this notion that it might go to 4,000 or it might go to 3,000, 2,000, right? So in that scenario, if it goes to 4,000, you'll be making money in equity position. But if it goes against you, you can incur significant amount of losses. So to save yourself from that and to deal with that particular thing, you can enter into an option, a call option. That's how options are actually, that's how options work. To lock a price by paying a minimal amount of money, and it's about buyer. If he choose to exercise it or not, it's up to him. Because let's say if you had agreed that you'll be buying something at 3,000 rupees, this many of quantity, and if you basically are not getting benefited out of it, you can choose to uh, refuse to exercise that particular instrument, right? But while the option writer has a liability, he has this obligation to exercise this anyhow, because he is getting the premium, right? And you are paying the premium. You uh, you understand options really well, so I don't think so we need to get into definition of options, but as hedging instruments. Let's see. So we have dealt with the definitions of all contracts that give the holder the right but not the obligation to buy an asset at a predetermined price within a specified period. Right? It's just like you buy some property or you rent out some property. Even if you buy a property, you are still living there, right? You can start your business from that property or whatever you want to do. If you rent that, you have all the luxuries to do all the things that you will be able to do after purchasing. But if you rent it out, you are just basically paying a minimal amount to execute all the operations which you were able to do post buying it, post purchasing the property. That's where the options, intuitively you need to understand options as this way. Okay, how can we hedge from options? There are two major strategies that we can do. There are tons of option strategies that you can do, thousands of strategies, customized, thousands of strategies you can do. But there are two major methods that you can do to hedge your instruments with options. So let's say here you need to focus in this picture. Focus in this picture, right? This dashed line is something. This dashed line is your directional position in equity, right? What does this dashed line says? That says that at 52 rupees, you have purchased the stock. You can imagine any number of, see, don't focus on this profit and loss. Just focus on this particular dashed line and this straight line, right? So this dashed line is basically, here it is showing that you bought some stocks of a stock at 52 rupees, right? So if it goes to 40 rupees, you will incur huge amount of losses. If it goes to 80 rupees, you'll be getting good amount of money. But what you will do is, how will you be hedging this? So what you have done is, if it goes to a certain amount of stock price, let's say below 50, you'll stop losing any amount of money. This is where the protective put is useful in, right? What you will do, you bought a stock at 52 rupees, you'll buy a put at 50 rupees with a premium of 2 rupees, right? So you have paid a premium of 2 rupees, just like the health insurance that we pay. It does not cover all the expenses, or it does not, basically it won't stop you from losing, but it will cap your losses, right? It has a cost of 2 rupees. So earlier, what profits you were making at 52 rupees, you will make that at 54 rupees. So now you have this difference of 2 rupees. So at 60 rupees, how much money you were making in this particular scenario in dashed line, you will be making it 2 rupees later in this earlier, in this later scenario, right? Because you have bought this 2 rupees put here. I hope you understand this. So we bought a stock at 52 rupees. We bought a put at 50 rupees, bought a put of strike price at 50 rupees. That means if it goes below 50 rupees, your losses are capped. It won't happen. I mean, even if it goes to zero, the losses won't incur more than this amount of money, whatever that amount is. I think in this example, we are expecting 100 quantities that we bought, right? Is there any question? I mean, see, we'll be taking questions in the last, but if somebody has any sort of, if somebody is like, I mean, if anybody has questions, like if I'm going faster or slower, or any sort of questions regarding whatever we had discussed till now, then we can get into that. I lost just a second. Okay. Yeah. Second strategy that we can do with options is delta hedging. Now we'll come back to that discussion where we were discussing the delta. What is delta? Delta is basically something that mimics how much of the movement happens in the underlying, and that much of movement according to delta will happen into the derivative. For example, here we have this delta of 0.55. What is this? What are these three pictures? Let me explain you. In this particular picture, we are seeing, just think of a scenario. We'll take real market examples here. So just think of this scenario that you think that markets are overbought, and in Nifty, markets will not be able to cross above 24,000 in June. What do? You can deal with this scenario by doing a lot of strategies, but you choose to go with call option, right? So what do? You'll be selling a 24,000 call strike price. How does that basically pan out? Basically, you are expecting markets to not close above 24,000. If it closes below 24,000, anywhere below 24,000, let's say 23,500, 22,000, doesn't matter. But if it closes below 24,000 rupees, you'll pocket all the money that you have sold that option for. So this is our initial position where my delta is 0.55. What does that mean? That means if we are expecting the lot size of 100 in this scenario. So if so currently I'm minus 55 rupees in delta, right? So if stock goes 10 rupees up, that will be moved up by 5.5. You understand why? Because you have to multiply this number by 10. whatever amount of money that happens, that increment that happens in the stock, it will be mimicked by 0.55 times, right? This is the delta of the call. How do we hedge it? Because we have expected, we are here making this assumption that we have 100 stocks. So basically, I am minus 55 delta, right? Every 1 rupee up, if stock goes, I'll be losing 55 rupees in this. So how can I hedge this? By buying 55 shares. By buying 55 shares, right? How does that delta, how is that delta calculated? We'll be looking into a hedge ratio example also, where we'll be understanding the risk management and how can we, uh, I mean, how can we hedge our portfolio using futures? We'll be looking about this there more. So for this delta, we have to buy 55 shares. Why do we do that? Because we have this notion of the markets that markets may not be able to close about 24,000 and it will not be closing below 23,000 as well. So we have this notion that somewhere around here to here markets will close. So that's the only reason that we hedge it completely. We will keep our exposure at zero. Okay, let me be clear about this. This is not as simple as it is seen, because this delta keeps on changing alongside with the markets. And we calculate the rate of change of delta with another derivative, second order derivative, which is called gamma. We'll not get into gamma, but just understand this, just how the underlying changes is mimicked by the delta. The delta changes, delta changes will be mimicked by the gamma, right? So as closer we reach to the strike price, the delta will keep on increasing. Delta, if the difference between the strike price in a for a call option, if we are going OTM, because we are at 23,500 and we have sold at 24,000 of call, so we are out the money. As we reach closer to 24,000, this number increases, right? But our shares, those are static, right? So this is where you understand that it must be a dynamic delta hedging, right? That we need to understand, we need to figure out. If somebody is interested in such sort of strategies, they'll need to they'll need to deep diver in this, because if it goes to 23,900 and the delta of it, let's say, increases to 0.65 or 0.7, so you need to increase the number of shares as well, right? Or if it goes to like, let's say, 23,000 and delta reduces to zero 0.3, you can decrease your shares as well. But all in all, if you keep this position as same, this is how the payoff looks like. I hope you guys understand the payoff. This is the basic assumption that I'm making, that this is the zero line here. And if the chart is above that, this is the price of the underlying. So between, and the orange line is basically it's something that is happening right now. So we won't be focusing on orange line, but we'll be focusing more upon this straight solid line, right? So this is where the position will be realized accordingly, right? So from here to here, we'll make no losses, and beyond these points, we'll be making losses. But if you have to go into dynamic delta hedging, then you can on a periodic basis, like every single day, or I mean, if this is a position which is going to expire in next 3 months, that depends that you are managing your delta every single week. If this is happening, the expiry is going to happen in the next week, then you'll be able to, I mean, you even will have to do it every single day or every hour. That completely depends upon how your strategy is and how comfortable are you with this many of charges, because delta hedging comes with cost. You need to understand that as well, right? Let's move ahead. There are few advanced hedging techniques as well, and I'm assuming that you are a bit aware about this: interest rate swaps and currency swaps. Let's make this a bit simpler. So don't get into the jargons, right? Like cash flows and different interest rates, and just think of it as a call option on interest rate, right? For an example, what is basically, why do we need an interest rate swaps? So let's say if you have bought a home, or if you're going to buy a home and you are scared of floating interest rates. Currently, you are basically your interest rates are, let's say, 8%, and you suspect that it might even go 12%, 13% in the upcoming future, right? So in that scenario, you'll have to pay more for the same thing which you are paying less for, right? How do you go and deal with this scenario? So in this particular scenario, if you have this kind of a scene where this might happen with you, what do you do? Basically, you interest rate swap. This is a thing where you buy a call on interest rate, and if it increases, you will get a payoff from there, which you can pay your bank, right? This is how it is dealt with, right? So whatever the difference is, difference of the interest rate is happening from here, you will be basically taking that difference, offsetting that loss from doing that interest rate swaps, right? Same as with currency swaps, you can think of it in terms of companies who are doing their businesses in, let's say, America, just like IT companies like Infosys or TCS are doing. So they are generating their revenues from there. They are spending money here. So there is this difference. There is this dynamic of currency, right? So if currency appreciates or depreciates, it actually affects them. So they also get into this currency swaps where they do the same kind of practices which we just discussed in currency swaps, in interest rate swaps. Please, I mean, I might go faster, so I'm going to encourage you again that you keep a notebook handy and write down the doubts. So at last we'll be able to deal with them.
Could
Now
you please
let's.
explain delta hedging once more? I didn't understand it nicely.
You
That,
okay? So please note it down. आप उसको नोट कर लीजिए. और डेल्टा
sure.
के बारे में अभी हम लोग एक बार ना विल बी लुकिंग इनटू हेज रेशियो एज वेल, because when we have to take care of hedging with futures, right? So we need to know how many of the quantity of futures do we need to go, right? I mean, let's say if my future is nudging, I mean, it's buzzing only like 50% of what my spot is doing, then in that scenario, do I need to go one on one? I mean, if one quantity of share I have in the equity, do I need to do one share of futures as well? एक arbitrary situation है. So अगर ऐसा है तो we need to know that hedge ratio, and hedge ratio is completely, you'll be able to relate this with this delta, right? So we'll get into it. Yeah. Again, hedging in practice. You guys are, I mean, see, I'm a bit new on Teams, right? So if my screen is not visible or something like that, because I'm constantly sharing my screen there, right? So if the screen is not visible, you can unmute yourself and you can ask for that, right? So let's discuss this in detail. How do companies actually deal with these kind of scenarios on more scalable issues, or let's say on wider scale of things? How do basically they manage their hedges? So there are two case studies that we can do. One is hedging the commodity price risk. See, example ke, for an example, we talk about Tata Steel, right? Tata Steel is basically dealing in iron ore raw material they take, and then basically they'll be making it a steel from it, right? Right. Basically, they are exposed to fluctuations in iron ore prices, right? Now, for an example, if they have this contract which they bought in bulk of an iron ore deal where they are costing they are costed around 100 rupees per kg of that particular raw material, right? Now, because the commodities are so volatile that this 100 rupees in commodity markets, this 100 rupees of price of that iron ore can go up to, let's say, 300 rupees in a few weeks, right? But will Tata Steel be able to increase their prices of their products by 3 times in a few weeks? They'll not be able to do that because they have to stay competitive in the markets, right? So if they how do they deal with this? Because this is the commodity, right? And this is exposed to volatility, and it can have wild moves in no time, right? how do they deal with this? Like they'll go into a futures contract, they'll sell it at a particular price. If the commodity prices drops, what they'll do, they will be making money from the future hedge. Whatever amount of money they're losing here by reducing their prices, what they'll do, they'll make the equal amount of money from the futures hedging position, right? Or simultaneously, if we talk about if it is getting expensive, what they can do is like they can buy it in futures markets, and whatever amount they are basically they are losing here from their products, their main operations, by keeping the price competitive, by keeping the price lower, even if that is increased in the commodity markets, because they are hedged, they are making money in the futures, and they are able to give that competitive price. This is how they basically use this. Now, this is something where they face losses also, because hedgings are a cost, right? It is a loss also, because for an example, if you buy health insurance, you are paying every single month, every single year, and if nothing happens to you, right, that is a cost, right? That is a cost which we consider for our well-being. Or for a car insurance, if your car doesn't get hit, if you never claim your insurance, whatever money you have paid for insurance, that goes to vain, right? But still we consider that, because we don't want any hassle. We basically, here our main operation, if we talk about Tata Steel, their main operation is doing business, right? Not making money in futures, right? So they have to do that to stay competitive. Second case study that we talk about is interest rate risk. So we talked about Infosys, right? So Infosys is a floating rate loan, and they use an interest rate swap to pay a fixed rate and receive a floating rate. So that's where you need to intuitively think about the call option, right? So they have this call option. If the floating interest rate increases, they'll get some payoff from there, and they'll be able to pay their loaners, right? So this is how this works. Risk management and hedging. Let's basically, I think we'll change in the format a bit, and let's take a 5 or 10 minutes of a Q&A session here, so that we'll in the upcoming topics, we'll get into them with a fresher approach, because there was a question about delta, and there are a lot of other people who might have some questions regarding what we have discussed till now. Is there any sort of question that you can ask? Then we can take a 5 or 10 minutes of time to do that.
So is delta is like price elasticity, which we study, which is like change in price with change in quantity, something like this, or it's change in price with respect to volatility only?
I can't hear you because your voice is so shattered actually.
Okay. And I meant to say that delta is like the price elasticity, like in terms of volatility, or it's
Still the same.
something.
Manish, still the same. I can't. Is there is there a problem in my speaker from my side, or anybody else is not able, is this facing the same from Manish?
Yeah, I will
Can you
try
chat
last
it out?
time. Yeah, I will try. There is no option to chat, I think, here. I cannot see it.
Okay. So you can, if you have to use the chat option, you can do
Uh,
that.
Manish, allow me some minute. I will open the chat and then you can post your question in the chat.
Okay,
Yeah,
okay.
okay. Is there any question? Yeah, Ayush, please go on. Ayush, you had raised your hands. Is there any question that you want to ask?
Hello. Hello.
Okay. Yeah.
I want to ask one question.
Mm-hmm.
You said we have minus 0.55 delta, so we have to
Yeah.
buy 55 shares. But delta
Hanji.
keeps changing every day. So
Yeah,
what
right.
if uh, delta is something less tomorrow? So we have to buy those share again.
Yeah. See, this is what the dynamic delta hedging is about. See, if the delta is supposed to change, right? Every other day, or see, if the market gets closer to the strike price that we sold, the delta is subjected to change, right? In that scenario, what you need to do is you'll have to, modify the hedge. You will have to tweak in that. That is something that you have to do every single day or periodically you can do. If there is an option that you have done, which is going to expire in 3 months or so, long dated options can be dynamically hedged. The periodically changes can happen every single week or a day. And if you have an option which is going to expire in next 2-3 days, then you have to do it on like every 15 minutes, 30 minutes, because in that sense, the sensitivity of change will be higher than that of on longer dated options. Is that clear?
Yeah, yes.
Okay. Is there anyone else who wants to ask the same? I mean, any sort of questions if you have?
I mean, yes. So if delta is changing, you said let's say delta is changing like from minus 0.55 to 0.6 or 0.7.
Mm.
So what is the percentage? Like how do we know that number? How many shares to add? So what's the
Yeah,
conversion ratio?
yeah, very good question. See, this is basically this is on one quantity of that call, right? That
Right,
number
right.
is basically, that is just a number, that is just the sensitivity. This is not quantified. How do we
Correct.
quantify it? We quantify it by multiplying it with the number of quantity that we have. So we have 100 quantities sold, right?
Right.
We have 100 quantities. We are considering a lot size of 100 in this particular scenario. I had taken an example of Nifty because that is more relevant. But think of it as this is an example where the stock price is of 100 rupees and the lot size is 100. So 100 multiplied by minus 0.55. What does that mean? That you are minus 55 delta. How much is your actual payoff? How much money will you be making from this position overall? You will be making 55 rupees from this.
Correct. If I get a
Right?
profit, that's right. Yeah.
Yeah, that's how. So if that stock goes to zero, you have like 55 shares. That's how you need to deal with this. Okay. Yeah. Any other question?
No.
Or shall we? Yeah.
Manish basically wants to ask, is delta same like price elasticity, but with respect to volatility?
Price elasticity with respect to volatility. Delta is nothing. See, intuitively, you need to understand the sensitivity of an option with regards to its underlying, right? So for 25, let's say, let me, if I can draw on the screen, I'll do that. Just a second. Let me do that.
So basically, delta is a sensitivity barometer to the underlying price.
Yeah. So let's say if the spot price is, let's say, 24,000, right? And the strike price is also 24,000, right? And the option type is equal to call. Call will always have a delta between 0 to 1. Put will always have a delta of 0 to minus 1. Why did we write minus 0.55 delta there of a call option? Because we wrote that. We sold that call option, right? We sold that call option. That's why, because we had a negative position, so that is quantified as a negative number, right? Now, the premium of it is, let's say, 100 rupees. And the delta of it, let's say, 0.7. This is one situation, right? Now, case 2, where the spot price changes to 24,200. Strike price is still 24,000 because that is something that is static. Option is also called. Premium will be changed. How much that will change? We are basically considering, we are assuming that from 24,000 to 24,200, in this 200 points move, the delta remained static, did not increase a lot, right? We are just assuming for now because the relationship to understand the relationship of delta versus, I mean, the underlying movement versus the sensitivity in change in the price of the option, that is something which we need to model, right? It keeps on changing every single minute. It keeps on changing every single with every single tick, right? So it is subjected to change a lot, but we are just for now, for simplicity purpose, we are just for now we are assuming that it stayed 0.7, right? For whole from whole move of 24,000 to 24,200. So the premium will, because the delta of 0.7, the increase, the part of this which increased is by 200 rupees. So 200 multiplied by 0.7 plus the earlier call option, right? That will be 240. This is how the relationship of delta can be understood. Now, delta also will change, right? Here, because now we are deep in the money. So now, somewhere around, let's say 0.85 will be the delta. This is an imaginary number, but close to reality that we can say. This is how the increment in the delta, because now we are moving above the strike price of the option and we are moving in the direction of getting right. So in an option, if you are proven to be right, there are higher probability. See, delta is nothing but the probability of an option. I mean, intuitively, you can understand that delta is nothing but a probability of an option to stay in the money. At 24,000, a strike price of 24,000, which has a call of a premium of 100 rupees, has a 70% probability that it will close about 24,000. While when it moved to 24,200, you were proven right. Now probability of you going right will also increase. So this 0.7 and 0.85 are two numbers which I have taken on my understanding. It's not something which will, I mean, it's a practical thing, but it's not something which is going to be the same, right? It can happen anything. So you need to keep that in mind. Now, if it goes to 24,600, you need to think in the probabilistic terms, where if market is moving up, the people who have these options, they are quite confident now, right? And the probability of is also increasing. So that is basically measured by delta. Intuitively, you can understand like this. Is that okay?
But usually in the real market scenario, once you're in the call, like in the money, the delta will be 1, right?
You need to be deeply in the money, right? Delta will be one practical scenario. See, I have traded for last 9 years. And if we talk about this, for it to go delta is equal to close to 1, it needs to go somewhere around here. I mean, where you can say, see, there is this usual move which happens every single week. Let's say if market is moving like 500, 600 points every single week, and if it has moved beyond a point, and from there, if the probability for it to go below 24,000 is like close to 0, in that scenario, it can go to, it will practically will never go to 1. Just something that that's how we understand it. But it can happen like this. If it goes above from the spot price, from the strike price, then this can happen, right? Is that understood?
Yes, Raj, we have one more question in the Q&A section. So it is like, while selecting OTM for hedging, do we consider other Greek also with delta?
See, we have to think of three deltas, which are three Greeks, which are really important for us. One is delta, because delta is the direct relationship that we got from the market sensitivity, right? That if it changes like 100 rupees and the delta is 0.7, then it will change by 70 more rupees in our favor or against us. 70% of the move will be mimicked if the delta is 0.7. But meanwhile, the change in the delta is also happening because of gamma. So we need to keep a note of gamma also. And the last IV, implied volatility. Because if implied volatility increases, that also affects the delta, right? When the implied volatility, so the relationship between the delta and implied volatility also needs to be understood. In general, they are positively correlated. So if the implied volatility of an option increases, the delta of it also increases. So if you want to keep that in mind, and if you want to prepare your hedges accordingly, then you can do that. But that's why I touched on that topic and said that this is something which is seen easy, but in order to do the dynamic delta hedging, you need to be really experienced. One thing. Second thing, you need to prepare for a lot of cost. See, if I'm periodically hedging my position every 15 minutes for a weekly option that I'm holding, just think about it. If I'm adjusting my delta every 15 minutes, in a day, I need to adjust it for like 20, 24 times, right? That is something that is a cost that I'm attracting, right? So that is also that needs to be kept in mind as well, right? You can't keep your, see, if you are okay with this, that if you are okay with this, that I can make money from this to this, then you can go and let these kind of settings remain the same. Then your payoff graph will look like this. But if you want your risk to cover every time, because here also you are incurring losses. No, if somehow market drops like really fast and goes so much below your this break even zone here, or above this break even zone for any reason, then you'll incur losses even if you have delta hedging. It will protect you, but protect you in a range, not more than that, right? Any other question? So let's, I mean, yeah, we have dealt with delta, and
So yes, one
we'll
more
touch up.
question. Yeah.
Mhm.
So all these Greeks, all these values, like you said, delta is going to be close to one. All these values is given by the market participants, or the price of an option is decided by the exchange or something
See,
when we
the
start.
trades are happening. The trades are happening because of the change in the opinions, right? I mean, you can have a bearish outlook. I can have a bullish outlook. So you can buy the same call option which I'm willing to sell, right? So the prices are changing because of the people, right? The options prices are uh, initiated doing the models such as Black-Scholes, right? So your theoretical prices are happening from there, but from there on, participants are trading it and they are making the market. Just like
Right.
any
So
other market, options are also, yeah.
so if it's going above 24,000 strike price, the spot is going, let's say 24,100, and market participants decided to give delta close to one also, right? It doesn't have to, they don't have to wait to go until 24,600 or 500, like
Mhm.
you mentioned.
Yeah,
If
yeah.
they decide to
No,
give
see,
one,
yeah,
delta
yeah.
of one, close to one, at 24,100, it still can happen, right? It's not like they
It
have
can
to follow
happen.
the, yeah.
Yeah, you're correct. No, so see, whatever we are discussing here is theoretical, right? But in empirical conditions, things can change, right? See, if there is a stock which is not liquid enough, and if market participants tries to manipulate it, they'll be able to do so.
Got it.
But it's not going to happen in regularized markets, or if we talk about Nifty, Bank Nifty, which is so big in size and so liquid, right? Because if you see, if the DI will try to manipulate markets, FIIs will counter them, right? Because this is where they have seen the opportunity to defeat them and to make some money by taking benefit of this discrepancy that they are bringing in the market, right? So ultimately, there is no. You might have heard about this arbitrage. There were few years ago, there were these opportunities which used to come every single day, that you'll be buying in NSE, you'll be selling in BSE, right? But as the era of algo trading and the systems increases, the arbitrage opportunities are now very little, right? Because that is already taken care by the algo trading systems, right? So if discrepancy comes in liquid markets, it will be adjusted so quick.
Okay.
So you can't manipulate liquid markets. Shall we move ahead?
Yes, sure.
Yeah. So now risk management and hedging. Now we'll talk about a bit of what kind of risks investment के अंदर हो सकता है your portfolio is exposed to, and how can we deal with those risks? Here, effective hedging is a critical component of a broader risk management strategy, right? So it helps companies and investors manage and mitigate the various risks they face in the financial markets, right? So there is this one risk you might have heard about is value at risk, right? What is value at risk? Value at risk, VAR, is a key risk metric used to quantify the potential losses in the value of a portfolio over a specified period for a given confidence level. Basically, VAR helps in understanding the risk exposure for a particular portfolio, and it's really crucial for determining the amount of hedging needed, right? So for an example, let's say if you have a portfolio of 10 lakhs rupees and you have done this VAR modeling on that, there are various methods for you to understand what is the value at risk of your portfolio by doing the historical returns, or by understanding the historical returns. And if the historical returns 95% of the times, if they are above a number, and 5% of the times if they are below the number. So in this particular scenario, if you have a portfolio of 10 lakhs and if you have this confidence level of 95%, and that 95% is given a VAR of 5%, that means 5% of the times there are chances that your portfolio can lose more than 5% of your overall portfolio value. So that will be like 50%, 50,000 rupees of the money. This is what is your VAR. So 50,000, above 50,000, your losses will be kept somewhere around like 45,000, 40,000, but it will only exceed 50,000 only 5% of the times. This is VAR. This is what the VAR basically tells you if the given confidence is 95%. 95% of the times you will be having loss lesser than 5% of your portfolio, right? But still, that is something that we are seeing here, that if the loss is this is the VAR value, how can we hedge that? That is also something that we need to understand, right? This is why I'm introducing this new topic where we will be hedging with futures, right? So value at risk, key metrics, right? 95% if your portfolio is 10 lakhs and the 95% confidence level, your VAR is 5%, then that means something. Okay. Hedging with futures. How do we? That's where now I want you all to understand this with really open mind, because I want your attention here. Because if you will be understanding the hedge ratio, you'll be able to understand the delta really well, though it's not that difficult. So basically, hedge ratio is nothing, but if you have a portfolio of 50 lakhs, right? And the value of one future contract is 2 lakhs, right? Here, one more thing which you need to understand, there is this rho, the correlation coefficient, right? Let me multiply that here, rho, right? Rho is nothing but the correlation between the change in the spot price versus future price. So for now, for understanding, for simplicity of this particular discussion, we are keeping rho at 1, because lot of times the difference in the stock price and in the future price will be correlated with 1. I mean, they'll be mimicked perfectly well, right? So in that scenario, if somebody who has a portfolio of 50 lakhs, and if the change in the future is similar to the change in the spot, then in order to completely hedge his exposure in the markets, he need to sell 25 lots of Nifty futures, right? That way, basically, what is taken care is that now his exposure in the markets is 0. So the people who are worried about some situations where the markets can wildly move between, let's say 5% up or 5% down, in that scenario, they can go with this hedge. So it's not advised for everybody, but people who basically are trying to only earn the premium between futures and the cash, if that discrepancy happens anytime, that this can be taken care. There is this concept of forwardation, contango. We'll not get into that, but just understand that there is this difference, which is called the basis. So basis risk is like if the difference between the stock spot and the future is like, let's say 10 rupees, that will be converged at the end. So the difference, if the future is trading below the spot price, if future is at 2000 rupees and the spot price is like 2010, at the end of the day, at the end of the expiry, they will be converged to the same price. That's where we are doing this hedge ratio by exposing nothing in the markets. We are still be able to take benefit of that amount, which is the difference between the future and the stock, right? Now, hedging is all that we can think of when it comes to mitigate our risks. But there are a few risks, also risks that we can say, or mistakes and pitfalls that we can say that are involved in hedging, right? So over hedging is one of them, because let's say if you have something that just like their 55 rupees is the only thing that you have there as an exposure in the markets. And if you will be buying like 100 shares, right? So you are over hedging that position, right? Or in that other scenario, when we had done this protective put, right? So instead of one lot, 100 quantity of it, we bought it 52 rupees, and 100 quantity of 50 strike price, we bought it 2 rupees. Instead of 100 quantities, if we'd be buying more than the quantity which is getting offset by this quantity, if we'll be buying like, let's say 3 lots, right? We are trying to be conservative about it. We are trying to play more defensive. It will only incur, basically, it will attract the transaction charges and it will only incur losses to you. So that's why that is something that we need to keep in mind also, that we can't over hedge our positions, right? Under hedging is also a problem, just opposite of that. If you are not properly hedging your positions, if you want zero exposure in the market, just like in the previous example here, you want a zero exposure in the market, and you are basically trying to earn from the premium or the basis risk of that. So basically, whatever the difference and the convergence will happen, and you'll get that difference as profits. And if you under hedge this, and if you are still exposed one direction to the market. So if markets, like if you are selling here 25, instead of 25, if you are selling like 20, so you are still exposed for a directional risk. If market goes down, you will incur losses, and the hedge will not work as expected if your purposes are different, right? Improper hedge ratios, yeah, that is also something important. See, here we did not involve rho in this calculation, but let's say if something where the rho is really important in the calculation, let's say the change in the stock price, here assume that there is the change in the stock price and the change in the spot price, futures price. So the correlation of these two, correlation between two, is not exactly 1 and 0.5. Let's say 0.5. So we'll be multiplying this number by 0.5. So what will happen now with the hedge ratio is like it will be 12.5. So nearest number will be 12 or 13. Instead of 25 quantity, now we need to sell only 13 quantity, 13 futures lots, right? We can't do 25 because we don't need to do that in order to, because our exposure is not that great, right? Our exposure is basically taken care by the hedge ratio only, and the hedge ratio is suggesting us to do 13 lots, and will not go with 25. So calculation of this row is also important. In most of the cases, if you are going with the same futures like Nifty spot, if that will be able to, if you will be able to buy that, and by shorting the Nifty futures, you'll be able to create this sort of hedge. So you need to calculate the proper hedge ratio also. This is something, a common mistake a lot of people do. What they do is, like, if they have bought Tata Steel one lot and they'll try to create a hedge, they'll sell one lot of Tata Steel against it in futures, right? But the thing is, you need to understand the correlation of it. By just getting into this example where we had talked about the Tata Steel commodity real scenario, how they hedge their positions, right? So in the prices of their goods, versus the prices of commodities, there must be a correlation, right? Their industry correlation. So if that is not taken care of or calculated beforehand, they'll be able to overhedge or underhedge because of improper hedge ratio. This is something which we need to keep in mind also. Ignoring basis risk. Yes, exactly. This is very important thing. Basis risk is nothing but the difference between spot price and the stock price. A lot of people tell it premium also, or if the future is like trading below the spot price, a lot of people call it discounted buy also. This is also, these are also the terms that people use. That is called the basis risk. And last, the question which a lot of you pointed out to, that if the delta is supposed to change every now and then, if that is floating, if that is subjected to changes because of volatility, because of gamma, because of underlying movements, so will our hedge work? So we need to understand that if we will not be monitor, see, if our ultimate goal from creating such hedges is to expose nothing in the markets, then basically we need to monitor and adjust our hedges periodically, right? We need to change our hedges. We need to keep on modifying the quantity that we bought or sold against that particular exposure in the markets, because the markets are changing and we need to keep on changing our positions with those dynamic market conditions, right? So I know, I mean, I might be a bit faster here, but these are the all strategies that we talked about. But we'll have 15, 20, 30 minutes. How much time is required to answer your questions? We'll have a Q&A session where a lot of people will ask questions, and the other people who are not asking, their answers will also be their questions will also be answers indirectly. So we'll take a short 5 minutes of break, and then we'll do the Q&A session. So I will encourage you all to keep your questions handy and just throw at me. We'll take a break of 5 minutes, and then we'll start again from here, from question answers. Hi all. Yeah, we can begin question answers. Yes, Ayush. Hi, is there any questions that we can deal with?
Yashraj, we have a question in the Q&A section. Are you able to see? It is from Aryan.
Okay, just a second. I thought well.
Should I read it?
No. Yeah, I can see that.
Okay.
So there were questions like a few minutes ago, which we didn't deal right away. So we'll deal with them now because there are a lot of questions about delta. So this question is delta same like price elasticity, but with respect to volatility? Sort of. You can say that. It's just like you don't see. If you have to get into the details of mathematics behind that, then there is a different thing. But if you have to become better at trading or understand this intuitively, then you don't need to get into complex things like elasticity and all. Just understand this, that if, let's say, if we talk about this y is equal to mx plus c, with a change in the x, a change in the y, which is basically related to x, is defined with m, right? M is something that you can see here is delta. So if the y-axis, if we are modeling, if we are plotting on y-axis the price of the option, change in the price in the option, and on x-axis, if we are defining, we are plotting the change in the underlying prices, then m is something which is the delta, right? That means if m is equal to 0.5, if change in the x happens by 1, the change in the y will happen by 0.5, because this is why, this is what the delta is supposed to be. Just keep it simple. If you have to get into math, I'll definitely be suggesting you some resources that you can go and QuantIJ is like working really fine in this field. So you can get in touch with them also. They are also providing education on that. Right. Then this question, I was having a doubt, like as while selecting OTM for hedging, do we consider other Greek also with? Yeah, that question is answered. I'll repeat that also. So if delta is changing because of underlying prices, but because of underlying prices, the gamma is also changing. And because of gamma, the delta keeps on changing with that particular thing, right? So there is this relationship between gamma and delta, which you need to understand. If gamma is something like the highest for ATM strikes. So the ATM strikes, why the gamma is highest at the ATM strikes? Because gamma is something which is basically telling you the probability of some option to go in the money. Let's say if currently market is trading at 24,000. So for a put of 24,000 and for a call of 24,000, they both have equal probability, as we can say that the markets can get into any direction here, right? So for ATM strike prices, the gamma is the maximum. So the sensitivity of gamma or the effect of gamma on delta is the highest at ATM strike prices. And it basically decreases as the strike prices goes farther from the spot prices goes farther from strike prices. So basically, it's like just like you keep on. Think of it as a bell curve, and the highest point of the bell curve, or the where we can say the frequency of it is the highest at where the ATM strike price is, right? And having a delta neutral position incurs huge costs. It's better for a market maker. How often do market makers delta hedge? See, market makers has basically they have to get into a trade and exit the trade so quick, right? So if they have such strategies in place, they can use it. But basically, they have to bag a very small amount of profit, right? And if they'll keep on hedging, they don't have this much of time where they'll be hedging delta with that thorough understanding or thorough style. But still, there are algorithms that you can make around that. But it's not that common as per as my knowledge that the market makers are delta hedging. Yeah. So there are a few questions that might arise with this particular session that we have done. So let me discuss those questions. So let's start from the beginning. What we had discussed, what hedging is. So there may be this doubt in the mind of people that what is hedging and why that is different from speculation, right? In speculation, we are creating one position. By creating a hedge, we are basically we are getting that we are securing that speculation that we have done. So if we had speculated that Reliance might go up, alongside with that, we'll be buying a protective put. So speculation is something that we had initiated a position in equity of Reliance, and hedging is something that we have bought a protective put that if it goes, I mean, if the stock prices fall so quick or so far from the current prices, still will not be losing um, more than a certain amount of money, which we are already willing to, right? So this is the basic difference between speculation and hedging. Second is, how does hedging impact the potential returns of an investment? See, hedging basically is keeping you safe from adverse movements, but it is costing also, right? So for an example, we had uh, seen that example of buying an option, buying a future, buying an equity at 52 rupees and buying a put of 50 rupees, right? That that 2 rupees cost is adding to your investment. So the money which you were making in at price X in where you were having only directional position, now you'll be making the same amount of money 2 rupees later, right? That is the cost of you. So basically it is decreasing your profits, but also the kind of safety that it provides, it is something that you must be thinking of going with. There are people who understand it that hedging is something that is done uh, by companies and large investors. No, hedging can be done at any level. Even if you are a retailer, you can do that. Just like the example that we have seen there, where you can delta hedge your strategies, or uh, uh, you can hedge your positions with futures, as we had understood the value at risk, where if you understand that 5% of your investments are at a risk of, I mean, 5% of the chance that you can lose this much of amount. So by exposing completely or by exposing a part of it, you can decrease that amount of money that you lose from that particular VAR level, right? So you can do that as well. So for an individual or for a particular investor, that is possible to do that. There are questions on how do you think the daily marking to market in future contracts affects the hedging strategy compared to forward contracts? And that is not a question, but that is something that you need to ask, that why in a forward contract there is a risk of counterparty, while the futures contract there is no risk of counterparty, or there is a liquidity, because daily mark to market is settled in future contract. So if let's say if you bought something in 1 lakh rupees margin and you incur and the market moves against you and you had a notional loss of 20,000 rupees. So the broker will ask you to deposit that 20,000 rupees in your account to maintain the margin. What it is doing, it is basically ensuring that all the times you have this margin which is maintained in the market. So there is, I mean, you won't be going bankrupt in this particular position. What if market, like if what if it is maintained, the market to market settled like 30 days, in 30 days. So in that scenario, if the market moves like 2 rupees, 2 lakhs rupees against you, right? In that scenario, you will go bankrupt and your broker basically will have a loss from your side of 1 lakh rupees, which is going to impact his profits also, right? There is this one thing that we specifically we will talk about, options as hedging instruments, because this is somewhere we have seen a lot of questions from, and people might have this question also: what are all those factors which influence the premium of an option? Because This is there was questions about deltas and there was questions about influencing of other Greeks also. So the premium is basically influenced by underlying assets price. How is the stock doing? How the spot price is doing? If it is going up for a call, the call price will because of the increment in the delta, the price of the call will increase because the market is moving in the direction. Strike price, if you will be choosing the far strike price, like for 23,500, if you'll be choosing like 25,000 rupees of call. So the probability for it to go in the money is very less currently, right? So the sensitivity or the movement in it against the underlying will basically move very less. So strike price is something which is also very important because it's very important for options to know that whether they are going to be ITM or not, or that is something which basically is defined by delta, and that's why getting into options which are very OTM, and if you are doing buying in them, there are chances that they will not, they'll expire out the money. That is something that you need to understand. So strike price also affects the premium of an option. Time to expiry also affects because the time value has a negative impact on options premium. As the time passes by, you lose every single day the premium which is contributed by time value. So uh, in OTM options, there is a lot of contribution is done from time value, right? So as the time expiration reaches, the decay in time accelerates, right? So that is also something which is, it basically happens like this. If I'll be having something to write, is there something that I can draw on? No, I don't know. Okay, no problem. Think of it as like this type of a curve where in the beginning, it goes like the gradient, the slope of it is lesser in negative, but when it approaches the expiry, it accelerates in falling. So basically, if time to expiry is less, that is also something which is like affecting the option negatively, and that too quicker, right? At last, volatility. Interest rates and dividends are two things which do not influence it a lot. On day-to-day basis, these are something which are the least influential on futures, on options, right? But underlying price, strike price, time to expiration, and volatility. Volatility is also, if the options is getting volatile, the price of it will increase because of the increment in the delta. Because if the market is volatile, the participants think that markets have increased probability. Both sides of participants will think that the market has increased probability of going ITM. The put buyer will also think that the markets can fall this because now market is volatile, right? It's moving like 300 points up, 300 points down. So the increased volatility is influencing the options price as well, right? Because the probability of going for that particular option in the money is increasing. Can option be used for assets other than stocks? It can be used for anything. I mean, you can do it on commodities, currencies, as we talked about the interest rates. So when somebody is like getting into this situation where the interest rates are floating one, right? In that scenario, he can buy call options on interest rates. There are products for that as well. So you might have seen that movie Big Shot, where a group of traders suspect that the housing markets of US may fall, that may, I mean, drop very drastically, right? What do? They sort of, I mean, I'll try to explain you in the simpler language. They do credit swaps. What does credit swaps do? They basically they had bought a put option on the US house markets. So people who were selling them those put options, they thought that they're fools, right? Why will you sell an option? Why will you sell a put option? Uh, I mean, why will you buy a put option of something which is never going to fall, right? That is their notion about housing markets. But the investors kept on buying, kept their premium kept on melting. It went to zero all the times. But there was one time when it gave them immense profits when the actual fall happened. And this is how the options work on such thing as well. So you can buy it on anything. right? Whatever instruments are providing that sort of luxuries, you can do that. There is this question which can arise also, like what is the difference between American and European? We as an Indian market participants, we use European options, we trade European options, which has a specified date where the expiration will happen. But while we talk about European option, we need to keep that in mind that American options has that luxury that you can exercise the option at any time you want, right? In that scenario, what happens is your options premium will be a bit higher because you are given that luxury, right? So the options will be a bit valuable in that. There is this question which kept coming in my mind when I was learning about options hedging also, that how would you decide whether to use call options or put options in your hedging strategy? What do we do actually? So basically the choice is completely up to you. The kind of risk you are taking, right? What kind of risk you want to hedge against, right? If you have bought a put, if you have a position in the equities, you will go for a protective put, right? While you are doing something else, any sort of option strategies you are doing, such as any kind of option strategies where you can go with the calls also, or you can do covered call strategies where, let's say, you have this stock and you want to generate income out of it, both the ways, where the stock is keep on increasing year on year basis, while always you have this call 2 strikes, 3 strikes far away from the current market price. You sell that call and you collect that premium because you understood the behavior of the stock, that it does not increase by 5% in a week, in a month. So what do? Like 5% from current market price, you will start selling those calls and you generate that premium. So the stock, every single month, the stock will close below that strike price. You are making money from options, from equities also. You are making money from call also. This is not a type of a hedge, but basically this is somehow hedging you a bit. So let's say 2500 is the price of the Reliance, and you sell a call option of 2700, and that has a premium of, let's say, 50 rupees, let's say. So now your effective cost of this investment decreases from 2500 to the minus the premium that you are receiving by selling that 2700 call. This is not hedging you a lot, but still it is hedging you a part of your investment. Now your effective cost, not 2500, it's now 2450, because 50 rupees you are getting from there. And we have already established that hedging comes with costs, right? So if you are hedging this with 2700 call, above 2700, the call will start incurring losses, right? And the investments will start earning more money above that. But the thing is, like, your profits will be capped at 2700. So that's why whenever you get into such positions where you're doing covered call strategy, you need to think that what kind of a strategy, what kind of a strike price that I need to sell in order that I'll not be. I mean, this is a trade-off which you need to do. I mean, I can't sell ATM call options because now my profits will completely evaporate by the losses which are offsetted, by the profits which are completely offset by the losses, right? That is also something we need to keep in mind, that we need to choose our strikes a bit far away by understanding the market dynamics, by understanding the nature of the stock as well. Because if the stock is very volatile, and if you are selling like 2 strikes, 3 strikes, or even like 5% away from current market price, and if it like the stock has moved like 100% since then, but you will only be capping your profits at 5%. That is something which is very frustrating. So you need to understand the nature of the stock also before getting into such hedges, which are partially hedging your position, but majorly eating your profits out. That is also you need to understand. Now, this question, which I didn't, I expected people to ask about, but people were busy in Delta only, in options, because I understand this is where the all of the interest is coming from since COVID. So there is this question which you might have, that what is the difference between interest rate swap and a currency swap, right? So an interest rate swap basically is involving exchanging of cash flows based on different interest rate, right? So here you have a fixed rate of 6% and the other different place you have a different kind of floating interest rate. So you basically trying to keep this arbitrage open, where whatever amount of money that you need to pay more, you are generating from somewhere else. So this is a cash flow kind of a thing, right? While currency swap is also dealing in the cash flows, but in different currencies, not in the same currencies. So that is something which we need to understand. There are more questions about how do companies decide the volume of futures contracts to enter into for hedging, right? So that is something which can be taken care by the correlation of their investments, if their main operations, and the commodity price. If that is something which is completely correlated, then if they want no exposure and if they completely have to make money from the main operations, they want nothing about making money in futures markets, then they can go equal amount of quantity what they have in their inventory. Again, if the difference is, if the correlation is different other than one, then they need to define it using this hedge ratio, right? That can also be taken care by this concept, hedge ratio. Now, if you have created, as a company, if you have created a hedge, and what if like the price of the iron ore, we'll talk about the Tata Steel only. So you bought something at 100 rupees and the iron ore prices goes to 300 rupees, right? So by getting into hedge and locking their prices at 100 rupees, they have kept their profits to limited to 100 rupees only, because now they cannot sell it. I mean, whatever, even if they are selling it at the market price, whatever the current market price is, whatever amount of money they are generating excessively from their main operations, that will be offset by the losses that they make in futures market. So this is something that companies are prone to. Yes, they lock in their prices just to stay in the game, and they don't intend to make money from futures market. They are just hedging themselves. Yeah, and there are a few questions that I have noted down about the VAR also. So what are the limitations of using VAR for risk assessment? See, VAR does not provide information about the magnitude of losses beyond the confidence level. What does it tell you? That 95% of the times your losses has happened less than 5% of your portfolio, right? It does not tell you the magnitude of what happens beyond that 95%. I mean, 5% of the times what happens, it does not deal with that. In order to deal with that rest of 5%, you need to get into conditional value at risk or expected shortfall that we see. There we will be taking a mean of whatever the maximum amount of losses is happening, and we can model an approximation. There are few other methods also to do this, like parametric way and Monte Carlo simulations. You can get into that as well if you are interested in this. There is a question, why might a company choose to hedge only a portion of its exposure rather than the whole amount? See, if you'll be entirely trying to hedge your positions, even if you are proven right by the market moves in your favor, then you'll not be able to make that directional money, right? So as we talked about this, that if I have a position where if one lot of Nifty is giving me a loss of, let's say, if my stop loss is hit and my loss will be like 50,000 rupees, I'm not okay with that 50,000, but I'm okay with 30,000 of losses. So what I'll do is that I'll try to delta hedge rest of that 20,000 rupees, so that my maximum loss does not exceed above 30,000 rupees. So companies do that as well. They have some directional bias from their investments, their operations. So they only basically try to hedge their partial exposure. So these are all the questions that I had, and I hope if you'll be having any sort of questions, we can discuss about that as well. Now, beyond that, I'm done with the session, and If any sort of questions you have, you can ask and we can deal with that.
Any question from anyone?
Should we conclude, Kshitij?
I guess we can conclude, yes.
Okay. Thanks for inviting me,
thanks
and
a lot.
thanks for all of you to join here and attend this session on Sunday evening, right? Yes, it's quite difficult. We were started with 40, 45, 50 people. It's okay. I mean, it's really difficult for people to stay till the end, but people who stay till the end will do magical things in their lives. Okay, good luck to all. Thank you for inviting me, Kshitij. And
Thanks a lot, yes. It was a great session.
and I'm really glad that you've done whatever you are doing with this kind of knowledgeable insights that you're sharing with people. This is a very noble work that you're doing. And I follow you on LinkedIn and I admire you, the kind of work that you are putting in front of people, doing for the fraternity. This takes a lot of courage and a lot of energy. Hats off to you, brother. Thank you.
Thanks a lot, yes. Thanks a lot.
Thank you, Jitesh.
Okay.
We'll
We
keep in
hope
touch.
to see you again at the cohort.
Yeah, I'll be there. Yeah.
Sure, sure.
Thank you.
Sir,
will
Thanks.
you be
Thanks,
sharing
Siddharth.
the
Thanks.
PPT?
Yeah, I'll do that. I'll do that with the Kshitij. So he'll take care with the participants. Okay.
Also, can you share your LinkedIn
Yes, sir.
ID?
My email ID is I'll do that on group also. Yeah. You can follow me. Yeah, I'll you can take care with these things with again you can deal with these things with Kshitij. Just ask him once. Or can I
Sure, sure.
drop it in the chat?
Sure.
Can
You
I
can
drop in
share
the
it
chat?
in Q&A, I guess. Yeah, sure. In the Q&A, you can share.
ये सो मेरा ये ईमेल आईडी है और लिंक्डइन का भी मैं आपको एक काम करता हूँ, लिंक भेज ही देता हूँ. Yeah. So you'll basically. So sorry, I was not that good with the teams. So drawing वगैरह के बारे में मुझे पता नहीं था. The session would have been more effective, but it's okay. I mean, I tried to do my best. That's the
No,
link
it was
that I'm
great.
sharing
Like
here.
we all were able to understand what you were trying to convey. It was in a very easy language, actually.
Yeah, I mean, I could have imparted the jargons also, but that wouldn't make sense, right? That is something. I mean,
Yes.
I'll put some resources with you that people can follow. I mean, I've been in the same WhatsApp group that you have created for quants.
Yes. Sure.
Yeah, so we'll communicate there as well. So I've put my
Sure.
email ID and my LinkedIn profile. Thanks all. Thanks again.
Bye, yes.